Hey, Robert.
Hey, Yaron.
Okay. So today we're going to talk about regulation, not our favorite topic or not our favorite issue, but important because we've been talking a lot about crypto. And there's no question that crypto is going to be regulated whether we like it or not by governments. And of course, regulation is probably a term that's broader than just government regulation. Markets can regulate, exchanges can regulate. There are a lot of different private ways in which regulations can happen. But it does definitely seem like there's energy now behind, both in the US and in Europe and in the UK, behind some form of regulation of crypto, and that this crisis in crypto, people losing a lot of money, usually motivates politicians to do something, even if it's not very good. So let's talk about the different the different ways in which regulations can be imposed on crypto, and then some of the proposals that exist out there. So I mentioned we were talking the other day, and I mentioned to you that in the UK, they have a different way of regulating financial institutions than the US. Maybe one of the reasons London became such a huge financial center, and that's kind of principle-based regulation so I have an example of this. It's pretty cool. So they give this example of, you can regulate execution of trades in a couple of ways. You can have a rule that says you have to execute all orders under 10,000 securities within one business day. And that's typically the way in the US they would do it. You just have hundreds and hundreds of rules. Or you can have a principle that says a firm must pay due regard to the interests of its customers and treat them fairly in executing trades. And that's kind of a principle based. And then you can go all the way to complex detailed rules where it's not just 10,000, but the process and exceptions, and you can have, and I have a feeling even that's probably the way the US. So let's talk a little bit about advantages, disadvantages of each one of those.
Well, I think that in general, when you think about regulation, that there's two extremes, and one would be no regulation, where you just let the market and customers and producers, financial service firms and financial service customers work all this stuff out. And there is zero reason to think that there would be no rules, because anytime people are left to work things out, they work things out in a way that works for them. And so that's one way that you can implement regulation. And another way is to have representatives, to have laws and a certain amount of authority vested into entities like the SEC that are then given the charter to regulate a particular financial activity. And so that's one dimension. And then within either of those, the dimensions is, how do you end up with the rules of the game that everybody knows and that people generally follow, and there are consequences if they don't follow. And those rules, again, could be there are no rules, and we'll just argue about any sort of conflicts once they happen. And that's sort of a legal settling up approach, which is super interesting, but it has its own challenges, right? Particularly if you have a legal environment like we do in the US. Or you can have very, very detailed rules, whether they're developed privately or developed publicly. You can have a very, very rigid regulation where there really isn't anything to argue about because it's all already been decided in advance. And they all have their pluses and minuses. And in any given situation, at any given time, there's probably some optimum, but it's not possible to solve some equation for it and to come up with, here's what we should do to make everything work the best right now in this situation.
Well, so, from the perspective of Ingenuism, it seems like what you would want is a system that allowed for change and provided the right kind of incentives for people to experiment and try new things and to change as circumstances change, as technology changes, rather than a political process. And this is the problem, I think, with rules-based, particularly detailed rules, is the incentive structure for change is not quite there. And the process for change is very cumbersome and takes a long time.
And the incentives for change. So, if you change something and it goes badly, then
Yeah.
you're in a lot of trouble, versus if you change something and it goes well, then you were just doing your job. And if you don't change anything, then you're not doing your job, but nobody knows it. So
Nobody complains. Yeah.
or we're the only ones who are complaining and nobody's listening to us.
Yep.
But the principles based is sort of the legal settling up. So if
Yep.
you have principles based, you need to have some sort of sense of, well, what do these terms mean, and so you need to have some norms that might be easier to evolve over time, but clearly have to have some transparency so that people can use them. And a good example would be LIBOR. LIBOR, the London Interbank Lending Rate, was the benchmark rate for literally trillions of transactions all around the world, because London was such a financial center and had been for so long. It was a norm. It was just something that it was the way things were done. And of course, LIBOR isn't a traded instrument, so it's not a market signal. So there would be an ongoing survey of, well, call up the bankers and say, how are you lending in the interbank market? And they would say, we're doing 3.71% or 372.4 basis points, or whatever the number would be. But it's a surveyed, self-reported number. And it turns out that, individual bankers would they would shade their estimate based on their book. So if they wanted it to be a little lower, they'd report a little lower, they'd report a little higher. And that turned into ex post for many decades.
Yeah.
That was not a problem. The numbers are small, but if you think about all the banks, across all the banks, the net position in this stuff is pretty much zero. So somebody's shading a little high and somebody's shading a little low, and they would average out. But at some point, people got upset about this, and it turned into a huge scandal, and LIBOR basically had to disappear. Now, you could argue that what replaces it as a market-based system is better, but it's all of it is very complex. Could a market-based system have worked better 50 years ago? Maybe not. 100 years ago, probably not, because communication of whatever the market signals was not instantaneous like it is today. So having a set of norms that can evolve is important. How they evolve is also important. It would have been, I'm going to say better. I mean, that's a judgment call, but it would have been better if LIBOR had evolved into something that was market-based over time, rather than running exactly the way it had for 100 years and then suddenly being forced to change, because you ended up with trillions of dollars worth of contracts that were citing LIBOR, which is something that was going to disappear.
Yep. So so the nice thing about the principle-based is, if there's communication, hopefully between the regulators and the banks, it allows the banks to experiment, to try to do new things and try to do different things. And, as long as they don't violate some kind of vague line somewhere in the eyes of the regulators, and the assumption is that if they communicate well with the regulators, then they can do a lot of different things, and again, I think this is part of why London became such a center. Whereas when the lines are clear cut, what happens is banks try to get around the lines in other ways, by creating various innovative products to get around those lines.
The ingenuity gets focused in the wrong places. And,
Yes.
The principles based, which I'm definitely in favor of, I just want to be very clear that it has its own challenges. It also allows the regulators to experiment and evolve. You have a principle, and it's a principle presumably that is good for the market. It's good for customers. It's even good for producers. You're not going to change the principle, but exactly what the principle means can evolve as the world changes. Right. Today, we have a specific rule of what is a security that has caught most of crypto. If you were starting today, you might be a little more nuanced in terms of how you define security, so that you weren't lumping crypto together with stocks, where there are similarities, but there are also very clear differences.
So let's talk a little bit about these proposals in terms of crypto, maybe.
Well, before we jump into that, I just wanted to, you said, people focus on figuring out ways around the rules. And that's such a great point to make, because, in the 1980s in the US, I'm going to say everybody knew, and anyone who understood the market knew that the US thrift industry was bankrupt.
Yep.
That, 3 out of 5 thrifts were literally bankrupt. They weren't necessarily at a point where it was obvious on the financial statements, but in reality, their assets were significantly below their liabilities. And that was because interest rates, it's interesting because rates are rising rapidly right now. And what happens if you hold long-term securities, you can imagine you all had a bank and you were making a bunch of mortgage loans last year. So you were lending out a bunch of money at 3% for 30 years. And then today, short-term rates are above 3%. Your funding costs are lagging, but by next year, they'll be above 3%. So you're earning 3%, you're paying more than 3%. You're basically screwed. Not only do you not have any net interest income, but you can't cover your costs. You can't. And that's exactly the situation that banks were in the 1980s. Now, in the 70s, when rates were going up, they just kept making loans at higher rates. They were trying to average up. So they, made their mortgage loans at 5%. And they made the mortgage loans at 7%. They made the mortgage loans at 9%. And now their funding costs are 11%. They've got a bunch of loans that are at 5, 7, and 9%. It just kept getting worse.
Yeah.
And so at some point, they weren't going to be allowed to grow their mortgage portfolios anymore. Plus, it wasn't working. And so they just switched to making loans that they could book revenue to offset these losses because they're paying a higher rate than they're earning on their assets. So they started making construction loans, because in a construction loan you can charge 2 to 4 points right up front. So you make a $100 million construction loan, you can book $2 to $4 million in revenue in what you can put in on as profit right now and offset all these losses in your ongoing portfolio. So they started making construction loans like mad because they needed the fee income. And of course, if everyone's making construction loans and in a time when the economy is really up and down, you end up with a bunch of shopping centers nobody wants and a bunch of loans that go south. And that's what happened in the 80s. And then everything had to be, the industry basically had to shut down. And it was, the credit unions didn't get shut down, banks didn't get shut down. It was thrifts because they had gotten on this path because of the original regulation. And the original regulation was you have to invest in mortgages. And the way we'll make it profitable is we'll cap the amount of interest you have to pay. So now don't worry about it. If you lend at 5%, we'll cap the interest you have to pay at 3%. So you'll always be able to make money. And that worked until rates went up and all the deposits started going to money market funds. And then they had to remove the cap and then it was over. So one rule.
And that was a rule passed in 1934, right? It was passed in 1934, but we only saw the disastrous consequences.
It worked for 35 years,
50 years later.
And then it started to break down and then it destroyed an entire industry. With
everything, everybody adjacent to it. I mean, it was a real major crisis.
And real is the correct word to use because they had all this money going into building shopping centers that existed only so they could delay the eventual failure of the thrift industry. It was a disaster for everybody, for capital allocation, for taxpayers, for shareholders, for everybody.
Yes. So in many respects, this is interesting because many respects, our banking system today is still governed by regulations passed in 1933 and 1934. Some have been modified, but many of them are still in place from back 33 and 34. And there's been very little change and innovation and improvement made.
So the entire financial services industry is completely changed in the last 90 years. It's unrecognizable. And maybe 10% of the rules have gone away because they were so bad they had to. Like the worst 10% went away because they caused these different crises. And then maybe 10% have been changed. Glass-Steagall did get altered, but 80% are that were written. It's like the Jones Act. Once we get into this, we could spend our entire time talking about how horrible this is because it's horrible. And it's catching up. It's catching crypto. But the interesting about crypto is so much of it is predicated on having fixed code. It's essentially trying to privatize the rigid regulation approach to how how the cryptocurrencies will work. And I love it because
So you mean there's fixed code? You mean the protocol that
protocol,
governs
exactly.
governs the coin? Yeah.
And I love it because the protocols can fail. If you were
And
going
they
to
can
have one
compete.
protocol, they
And
will
they compete.
compete, and that's why
Yeah.
they'll fail. And we'll learn from that, and the protocols will get better, and they'll evolve. It won't be that protocols evolve; it'll be that they're allowed to fail. So the other thing we could have is we could have different regulatory agencies and have the worst of them shut down every decade by some objective metric, and then start a new one. That would be the equivalent of what crypto is doing. So what crypto is doing internally is already way better than what regulators can do from an Ingenuism perspective. There's opportunity to evolve not just the business models, but also the rules of the game. And both of those, given how early we are in crypto, both of those are probably going to be unrecognizable in 10 or 20 years. And they should be. Yeah,
I mean, you remind me, you say the regulatory agency would close, and we still have regulatory agencies from the 19th century that have nothing to do with what they were originally instituted for. The control of the currency is probably the best example of this, instituted during the Civil War, because the government printed money for the first time, really in large, to control that. And yet today is one of the many agencies that regulate banks. Why we need it, nobody knows. Nobody can understand, but it's there.
Nobody even asked the
Never
question.
go away.
Since I mentioned the thrift crisis, the agency that was set up to resolve the thrift crisis. So you actually set up a agency to take on all the failed assets and to liquidate them and get back what they could for taxpayers. Is one of the few government agencies that closed on schedule. They did their job and then they shut down. So it's possible, but I hear you. It's a
very
hypothetical and naive idea, but it is what crypto is doing. So the way I view anything that's coming out of Washington or the States is, are they allowing for that kind of dynamism? And 100% they're not, at least so far.
So a lot of the effort around regulating crypto right now, because I think it's a low-hanging fruit and it's understandable, is to regulate stable coins, is to figure out how to, because stable coins look a little bit like a money market fund or like a bank. You take in deposits and you give out loans. So they're trying to regulate them as if they're a money market account or a bank. So we got a number of proposals, I guess, in the U.S. for the regulation of stablecoins.
That's definitely the low-hanging fruit. If people understand it, it makes sense. Like, it's easy to argue for. I could argue against it, in the sense that you don't have to regulate beyond maybe disclosure, but even that, you don't really have to regulate money market funds. But crypto got ahead of itself. What do they say, like over their skis, where in addition to the stable coins, they started building protocols that look like banking. So having Terra Luna, where Terra is locked up in the Anchor protocol, is paying interest, and suddenly this looks a lot like a bank. And these have been the big failures, because they're basically doing what the thrifts did. They started promising 18 or 20% with no obvious value creation behind it. So it works as long as there's enthusiasm, but that's really all you're selling. And those kind of examples, things that look like Ponzi schemes, are going to attract regulation like honey and bees.
Do you remember in the 1980s, the Wall Street Journal would literally list, I think every day or weekly, a list of the highest paying, the banks that paid the SNLs that paid the highest rates on deposits. And it was double, it was 18, it was 20%, because they were trying to get money in. And because of deposit insurance, people were sending the money. And of course, and it looks like these regulations, some of them want to have deposit insurance over stable coins, will generate a very similar phenomenon.
It was, amazing that people would put deposits in to insolvent, wildly insolvent and extraordinarily risk-taking with, asymmetric payouts to where the upside is to shareholders, the downside is
Mhm.
to debt holders. Except with deposit insurance, it's actually crazy if you weren't putting money in.
Yeah, exactly.
If the U.S. government had insured the anchor protocol, then oh
Yeah.
my God, why not? Interest rates are zero, and you can get 18%. And when it fails, which you will, they'll pay you off in dollars. Like, sign me up.
Yep. But that's what, like, the Stable Act that's being proposed, was it in the House or the Senate, is they're trying to turn stable coins into banks. They want them to register. They want to have deposit insurance.
There are even
It's
proposals that only banks, insured banks, can offer stablecoins.
yeah.
Yeah.
I mean, in a sense, that makes more sense from their perspective. It's easier. You've got the regulatory mechanisms in place. You don't have to deal with these new entities. I'm not sure. It completely destroys the whole idea of the innovation and the ingenuity that is associated with this new product and with the experimentation that is coming with it. And yes, sometimes experiments fail.
And we're protected in a way. We're shielded from this instinct to just apply the rules from a century ago to whatever comes along by the fact that crypto is a global phenomenon.
Yep.
You can make rules for the US, and you can even try and enforce those rules on the rest of the world, because it's a real problem.
Yep.
But it's not as easy as if you could just say, oh, okay, this particular activity, you can only do it if you are a bank. So you may recall when Robinhood was first creating cash brokerage accounts, and they were going to call it Robinhood Bank. And boy, did they get slapped down like within 90 seconds of tweeting that. And I am not, given the world we're in, I'm not opposed to that, because bank means something. And in the US, it means deposit insurance from a customer's perspective. And I am a big fan of disclosure. I'm a big fan of disclosure being market driven. I don't see why the SEC makes it. I don't think the SEC makes better rules than the NYSE does. And they make one rule as opposed to the NYSE, and the over-the-counter markets can have two different rules. And there's certain advantages to being able to go into a bank and know that your deposits are going to be insured and not have to spend any time thinking about that. Like, we don't want to all evaluate the credit risk in every aspect of our life. And we need to recognize the cost of having things get rigid. And so given that we have all of that rigidity in the existing financial system, applying it to something new like crypto just seems bonkers to me. Where you could create a completely different, because people don't think of Bitcoin like, oh, if I buy $1,000 worth of Bitcoin, the U.S. government will guarantee I'll always have at least $1,000 worth of Bitcoin. Nobody's thinking that. So you have this opportunity to create a set of new rules. And the question is, how do you come up with those rules? Because if you're not just applying the existing rules, then it's actually work. And it's not easy. And the SEC is not interested in creating rules out of the gate. And frankly, I don't think they should, because I don't think they would know the right rules to create. The only rules that they could create out of the gate are to apply the existing rules to crypto. I think it's a terrible idea. And
that's what Congress is trying to do. So, but there is this experiment, it looks like, in the UK again, maybe because of this tradition of principle-based regulation, of the sandbox that the Bank of England is talking about, which sounds, I don't know the details, I don't know if you don't know the details, but it sounds at least like it's a place where they'll allow experimentation and to see what evolves, kind of defer to the market, at least as the first pass.
I really like the idea of the sandbox and having something where you're creating a limited area. And most people think of it as, okay, that we won't let them get out of the sandbox. We're going to keep them in the sandbox. And the reason I like it is because we're not going to let the adults in the sandbox. We're just going to let the kids play there. And so the adults can't go in and screw everything up. But you get both at the same time. I just think the benefits come from not the constraint built around the sandbox, but the guard rails that the regulators set to keep themselves out. And once once you frame it that way, it's a lot easier for Parliament to say, okay, well, we'll leave that alone because crypto's new and exciting, and this is clearly distinct from the system, and it's not going to be contagion, and all the things that people just go blah 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 like it actually matters, but it ends up motivating crazy regulations. And I do want to make a point that there is another advocate for crazy regulations, which are basically your leading incumbents.
Yep.
The biggest proponents for, well, let's get some fixed rules out there, will generally be, and in crypto it hasn't been. I think there's some of it, but generally I think the overall the beginnings, the origins of crypto created a certain set of norms that don't have people immediately look for regulatory protection to their business because they had got in early. But most in financial services, and I will go out on a limb and say it will happen in crypto because it's happened everywhere else. Eventually, the incumbents will become the enemy, and they'll want regulation that fixes a set of rules, that locks in their advantages and helps maintain their dominance.
Yep. So it is going to be interesting to watch, and I do think the fact that crypto is global, that it can move around very quickly. It is less dependent on geography. That obviously a bank that has a physical presence, and there will be shopping for kind of the best regulatory environment. And it looks like the UK and maybe Switzerland are kind of leading in that effort. Among the developed economies, at least. I know some of the undeveloped economies are doing all kinds of funny things with crypto, but at least in the developed world, those two seem to be at the forefront.
I think there's a chance, I mean, we're seeing it so far, that we'll get some regulatory competition in the US. I mean, the most obvious place has been the SEC wants crypto to be deemed securities, and the FTC wants them to be deemed commodities, because the SEC regulates securities and the FTC regulates commodities.
Sure.
And to the extent that you have a push-pull there, there's an opportunity. And look, I believe that people who work at the SEC are really interested in something coming out of crypto. They just have bad incentives. They're very risk averse and very control oriented.
Well, and they might not have the right level of knowledge too. Crypto is not easy to figure out conceptually.
Absolutely. And it's going to change, and it already has changed. Nobody was talking about algorithmic stablecoins 2 years ago, and how it's one of the big drivers of why people are pushing to, while people in power are pushing to regulate. And at least the SEC and the FTC probably can spell crypto, unlike Congress. But I haven't given up hope on the U.S. I don't have a high degree of, I have zero confidence. I don't even have a high degree of hope for U.S. regulatory process.
Yep.
And nothing has come out that's absolutely crazy. Focusing on stablecoins and being rigid around stablecoins, that's the least damaging and makes the most sense, has the biggest upside in terms of creating a standard that people can just depend on. I don't. Well, they did
eliminate the use of coins for capital raising, right? So that was harmful and kind of nipped the experimentation before it was really had a chance.
It forced it though to evolve into something that is probably a lot more interesting, because look, if you're just going to sell coins like you would sell stock to avoid regulation, I like the competition, but you're going to see a lot of there's going to be a lot of damage early on before the private norms evolve, and just replicating what the stock market does with coins, not that interesting. But having crypto where you have some blend of stable coins and those may or may not be utility tokens that may or may not be stable, and governance tokens that may have some characteristics of equity, although not the cash flow rights. They may have some valuable governance rights. Like that sort of blend is much more interesting than what we see in the stock market, where you typically have, if you have dual classes, it's basically a control issue. So you basically have plain vanilla, one size fits all for all companies. This is what you can do. It's really rigid, and it works because there's advantages in standardization. But let's try some other, more
Yep.
complex, particularly in the 21st century. We ought to be able to handle something a little. I mean, in early 20th century, stocks were considered crazy speculative. They were basically like crypto, and if you
Yep.
were an investor, you bought bonds.
Yep.
So there was a time where stocks were like crypto, and they evolved this regulatory structure, but they evolved it in a very world where people traveled by railroads and didn't have antibiotics. I mean, it was a crappy
Different
world.
Yeah.
And now we could do something better.
Yep. Good. On that hopeful note, I'm sure we'll be back to this topic again as the world kind of figures out the different regulatory regimes and actually puts them in place. For now, it's mostly just proposals and speculation. Nothing is actually in place, which is good. So nobody's rushing to regulate these things, which is a virtue. But we'll be talking about this again. Thanks, Robert.